It's official, guys. The stock market is having the worst start of the year since 1939, and we are currently at 14-month lows, a lot of stocks hitting 52-week lows and below. The CPI and PPI numbers just came out. We are here to talk about that, and I will be telling you why and when I'm going to start loading up on stocks. I already started selling cash secured puts, but we'll get into the trades and what I'm looking at later in the video. You definitely want to stick around for that because I will be sharing with you some metrics historically that point to stock market bottoms. I'm not saying we're at a bottom now. I'm just saying that there are metrics historically that we can look at to tell us how close we are to a bottom and when that will be. Let's get right into it. So the CPI and PPI numbers came out today and yesterday. CPI is Consumer Price Index. PPI is Producer Price Index. These two metrics give us great insight into what's going on with the economy. The Consumer Price Index basically meaning inflation, what consumers are paying for goods. And the Producer Price Index is the measure of prices received for producing those domestic goods. Basically, the higher these two numbers are, the worse it is for the overall economy, especially if GDP is slowing and wage growth is at a stagnant rate. This is what is called stagflation. Now, as I said in my very previous video, that if inflation comes in higher than expected, the market will continue to go down. If we get a surprise on inflation and it comes in much lower than expected, then we can start thinking about a market bottom. Well, the estimate was at 8%, and we came in at 8.3%, just shy of the 8.5% that we saw last month. These are year-over-year numbers. Now, the Producer Price Index was expected to come in at 0.8%, the core print, which strips out volatile food and energy prices. Don't ask me why they do that. Obviously, I know why they do that. It's because if they actually included volatile food and energy prices, the print would look a lot worse, since those are two of the main commodities that we see rising astronomically to levels we've never seen before. Analysts were expecting 0.8% growth in PPI. We came in at 0.4%. So we're still very high. The summary of both of these things is that we are still extremely high, even though it looks like things are starting to peak from a price standpoint. But we are nowhere near desirable at these levels. And as I stated in my last video, these numbers had to come in much better than expected in order to stop the bleeding. The NASDAQ had 5 weeks, 5 red weeks, which we haven't seen since the COVID crash of March 2020. You have to go all the way back to 2008, 2009 to get more than 5 weeks of red. And it looks like we will end this week red as well because we just got another red print on the NASDAQ. This will be the 6th red week in a row if we close here, unless we miraculously moon by, 7, 8% in one day. The S&P 500, not quite in bear market status. We have about 2% left to go. Obviously, I think it's inevitable that we get there. We might even go lower than this. The thing you have to consider is that earnings were not good either, right? So we got pretty muted earnings all across the board, some terrible, only a couple of better than expected earnings. And then we had the CPI and PPI numbers come in showing that inflation is still very hot, even though it looks like it's peaking. But we don't really have any real reason to rejoice here. However, how close are we to a bottom? When can we expect the bleeding to stop? When should we start buying stocks? Well, this is what I want to get into in my next segment. So let's get right into it. So there are a few things I'm looking at. One is the VIX futures curve, okay? So I don't mean to lose a lot of beginners here, so I'm going to try to simplify it as much as possible for everybody to understand. But the VIX is the volatility index. This is basically the fear gauge that investors and market participants use based on what is going on in S&P 500 options. So market makers and investors alike, institutions, etc., use S&P 500 options in order to hedge their portfolios. If you're holding a large amount of stocks, especially S&P 500 stocks, well, you are likely going to be buying puts during times like this, as we are as well in our private trading group. Usually, VIX futures look like this, meaning that market makers are anticipating that the volatility is going to be more in the future since there is more unknown than less. However, currently, VIX futures look like this. This is called backwardation, meaning that the future VIX contracts, right, market makers and participants are finally deciding that volatility is going to be less in the future than it is now. Now, this is good from a long-term standpoint. It means that your long-term positions, if you started buying here at least based on market sentiment, that your long-term positions from this point are likely going to be okay. But this still could spell disaster in the short term, meaning we have more of a drop coming since volatility in the short term is still expected. Now, I started selling cash secure puts in beaten up names, stocks that I want to own for the long term and I want to buy at a discount. For instance, I sold the 400 put on Tesla expiring October 21st for $2,500. If I get assigned, I get to buy 100 shares of Tesla at $375. That is a ridiculous price point for Tesla. That's 48% down from where Tesla is currently as at the time of this recording and 70% down from highs. I'd be happy to take that. And if Tesla never hits that $400 mark by October 21st, then I get to keep $2,500. Sounds way too good to be true, but this is the power of selling options versus buying. Over 85% of options expire worthless, so sellers make most of the money, and it's easy to see why. I also sold cash secure puts on Apple, which would give me Apple at 124. I sold cash secure puts on Microsoft, which would give me Microsoft at around 204. And I sold cash secure puts on the triple Qs, which would put me at around 239. Happy to take those price points on all three of those. If those don't hit the strike prices, then I get to keep the money that I sold those puts for. If you want access to all of our trades, long-term, short-term, our options, day trade watch list, which we send out every single morning, our analysis, etc., the coach's corner, the beginner section, link is in the description below. It's a great value. Would love to have you come be a part of a group of thousands of traders. All right, so two more things that I'm looking at before starting to buy heavy, even though I did sell those cash secured puts. So one of which still has to do with the VIX, and it's called the VIX curve. Not the VIX curve that I just showed you, which shows that the future contracts are worth less than the current ones, but the VIX curve as it relates to the 2-month forward contract minus the current spot for the VIX. Again, not to lose any beginners, all this means is that historically market bottoms have popped when this has been minus 10 or lower. If we look at the VIX now, we are currently at around minus 2. This is the 2-month forward contract trading at around $31 and change, and the VIX is currently $33 and change. So not quite there yet. So that would be just one of the other indications that I would look at. All right, another thing that I'm looking at is the CBOE put-call ratio. The CBOE is the Chicago Board Options Exchange, the main options exchange we have in this country. Basically, the New York Stock Exchange or NASDAQ for options, right? Yes, it's based in Chicago, not in New York. The higher this is, the higher the puts are. Just like with market tops, right? When we have market tops, there is ultra exuberance, so we have the largest number of call options. Same thing with market bottoms. When we have the most put options relative to call options, that is usually when we have market bottoms. And if we look at this historically, you could see that all of the bottoms of the market crashes is when the put call ratios, at least the recent ones, when the put call ratio was above 1. So the COVID crash of 2020, the put call ratio was 1.3. Back when we had the correction in 2018, December 2018, it was 1.07. Back when we had that double dip correction in 2015, 2016, it was near 1 in 2016, slightly above 1 in 2015. So the closer that this number gets to 1, the closer we usually are to a bottom. Here's one thing to consider, though, is that if this is not a full-on market crash, so if the S&P 500 and the NASDAQ just start reversing from here randomly, at which, to be honest, the chart doesn't look like that's the case, but let's just say it does, then this wouldn't be considered a market crash in the same way that we had in 2020. However, the correction that we had in 2018 was very similar percentage-wise to the correction that we see here. And back then, the put-call ratio was over 1. So I'm intently looking at this. You can look at this on ycharts.com, which I think is part of Yahoo. You can Google CBOE put-call ratio and continue to look at this every day. Right now, we are at the highest level that we've been, I believe, in all of 2022. So this is a sign that we are nearing a market bottom. Not saying we are. We could have 5 or 10 more % to go. I'm just saying that we've had such a large drawdown that the put-call ratio is now at a 2022 high. And this is when my ears and eyes start getting perked up. That's all I'm saying. And the last thing that I'm looking out for is a huge spike in volume. We want to get what is called a capitulation spike. This is when investors finally give up, seeing no light at the end of the tunnel, throwing their hands up, selling all of their stocks at a market low, at a recent low. And you tend to see these huge spikes in volume. If you see here, these huge red spikes in volume when we have these deep V corrections and deep V crashes. Even 2018, you have this huge spike in volume. This orange line here is average volume. And when we go significantly above that, it looks like two or more lengths of volume above that is when you usually start to get market bottoms. Even in the double dip correction of 2015, 2016, we saw this, and we haven't quite seen that yet here. I do think there's a bit more capitulation to go, especially since we don't really have any catalyst between now and the next earnings season. I mean, we do have the next CPI, PPI prints next month. Those are going to be important, obviously, and it looks like the market can continue to be extremely volatile until then. We don't really have any good news upcoming. The one thing that I can see that would halt this bleeding for a while is if we get some sort of white swan event like the war in Russia-Ukraine all of a sudden coming to a halt, or the lockdowns in China, for instance, the COVID lockdowns in China being lifted all of a sudden, right? I could see that being sort of a stopgap in what is currently happening. But in terms of a sustained rally based on fundamentals, it's really going to be when the market decides that the Fed has the ability to control price instability. That's really all it comes down to, because once price instability is controlled, that staves off a potential recession. That means that companies can now focus on earnings once again. We won't really have the threat of rising yields, which diminish companies' earnings as well. And I think we are pretty far away from that, especially based on the recent data that we are currently seeing. So in my view, I think increased volatility until the next CPI, PPI print and until the next FOMC meeting, where we will see whether Jerome Powell and his gang will now be forced to go above a 50 basis point rate hike, maybe to 75 basis points, maybe a shock and awe scenario where we get a full point raise, which I don't think will happen, but you know, some are calling for it. Anyway, traders, if you want access to all of our trades, the cash secured puts I'm selling, the stocks that I'm buying, when I'm planning on buying stocks, our long-term analysis, short-term, etc. Link is in the description below. Come be a part of a community. Don't trade alone, especially in this environment. It's not good to be alone. Comment down below. Let me know what you think of this. Hopefully you got something out of this video. I try to answer every question, so comment down below. Hit that thumbs up. Stay safe out there, traders. Peace.